Welcome back to Lunch at the Market. Today we're talking about technicals according to Magnum Opus Financial. That's us. First, what are technicals? That is what we divine from the charts or graphs of price action of a stock. Now you ask, what's price action? If you strip out everything and just look at a picture of what prices a stock sold for over a period of time, say 1 month, you'll get a line. That line may be up, down, squiggly, or all over the place. That line is the price action of a stock, and technical analysts, those that read charts, determine how they feel about a stock based on their technical analysis. Over here at MOF, we are fundamental analysis. We take a look at debt to cash flows, PE, PEG, and all sorts of measures to determine if we like a stock. But there's one technical chart pattern that we do pay attention to. That is the gap down. When a stock closes at a price one day and then opens up the next day significantly lower, that's referred to as a gap down. Because the line from one price to the next is not continuous, so there is literally a gap in the picture of the chart because it gapped down. Sometimes this happens in the middle of a trading day when news comes out that dramatically alters the price of a stock. That's still a gap down, but it takes place intraday. Sometimes they'll draw a line and disguises it, the fact that it gapped down. As value investors here at MOF, we like to see a stock gap down as long as the company isn't broken. Many times when a stock gaps down, it's the stock that's broken, not the company. Our goal is to exploit the inefficiencies the market gives us. We usually are on the side that believes that the gap down is mispricing of a stock. It usually represents capitulation selling, and it flushes out all the weak hands. Usually, the only people left after a stock gaps down are those who really want to own it. Most of the traders are scared off, and you're left with the investors. As long as you don't get a second piece of bad news or data, usually the stock recovers. This is how we've made significant gains last year, taking advantage of buying the gap down. So let's take a look at several stocks that have gapped down recently. Kewaunee Scientific, a company that makes furniture for scientific purposes like hoods, lab benches, etc. They traded at $16.05 on February 25th, then $13.90 on February 26th. That's a huge drop, and we think the sell-off is overdone. The symbol is KEQU. It's a small cap name, local to us here in North Carolina, but the dividend is now 3% and the company is growing. The stock trades with an 8.67 PE. Next, Boston Scientific, BSX, closed on March 12th at $7.80, opened up on March 15th at $6.60. That was a huge drop in the stock and has hung out right around $6.93 mark for 3 days now. We think it's forming a base and should set up for an eventual hot move higher once all the selling is done. When there are not enough sellers to keep taking the stock down, that's a great sign that the move is overdone and you should be fine getting in. It's called flushing out the weak hands. It gets rid of a lot of the fast money and leaves you with either investors or new fast money that should be around for a little bit. Some of the new fast money will keep the stock down temporarily if they manage to buy the very bottom in the price action, but they'll eventually all be done. American Dairy, ADY, closed at $20 on March 15th and then opened up at $18 on March 16th and immediately traded back up to $20 and closed around $21.50 on the day. That was a gift to be sure on ADY. China Sky One Medical closed at $17.21 on March 16th and then opened up at $16.26 the next day and traded down to $14.50. The stock then gapped up the next day, a very nice sign, kind of like the reverse of an island reversal, where you want the stock to gap up instead of seeing it gap down after another gap. Now, you guys are going to love this. This is a Magnum Opus Financial Classic, giving you nice technical pictures, or not, but we're going to try to see if you can see this. I drew a picture. Okay, this is an island reversal. Here you see the stock moved up. Here's where the day ended. It gapped up and then it gapped back down and about maybe a little lower than where it started. So that's called your island reversal when the stock gaps up. Sorry. Like I said, we're really technical here. Here is the opposite of an island reversal. Here the stock's moving and the gap's down. and then gaps right back up. So that's your picture for today. For those of you who like to not only watch video, but actually see the pictures involved. Okay, so back to what we were talking about. Finally, the most speculative name on our list of stocks that recently gapped down would be buyers of Fuqi International. Now, please be aware that you're breaking one of Jim Cramer's rules and you could lose everything. That being said, when this company reported an accounting error, it had to restate its earnings, causing the stock to go from $19.20 to $12. That is a massive repricing, and the volume was enormous on the sell side. That being said, if it really was an honest mistake and not funny business, this stock can rally more than 50% from here, not to mention any future growth that the company may have. It's a jewelry company in China. Think of like Tiffany's, only in China. It may not be that high end, but with the growing middle class in China, the success of a company like Tiffany's that we've seen of late, we are buyers of this name on a massive gap down if you want to roll the dice on this one. It's our big time spec play. Hope this explanation of technicals was helpful. If you have questions about this or anything else you see on Lunch at the Markets, you can go to the website www.magnumopusfinancial.com and click on the Contact Us section. Thanks for joining us today, and we'll see you tomorrow.